Does buying a house right now seem absolutely impossible? Prices, interest rates, no new construction or inventory. Despite all these hurdles, we are going to share on this episode how buying a home today is still possible. Hello and welcome back to the Happy House Hacking Podcast, the podcast designed to help young people in California on the path towards happy home ownership. And I am your host, Owen Schwaegerle. I'm a realtor, investor, and happy house hacker. And on today's episode, we are going to talk about the complexities of the real estate market right now and how you can overcome them to become a successful and happy homeowner. So let's be honest. When we look at real estate today, it seems extremely difficult to buy a home. And in California, it's gotten really, really expensive. Right now, the median sales price for a house in California is $900,000. How did homes get this expensive? It's just overwhelming. It's crazy to think about. And so today I want to share with you some data and go through what's been happening in California and the nation as a whole, why homes just continue to get more and more expensive each year. So I'm going to be sharing a little bit of data with you, and it really comes down to number one, affordability. So here is an infographic on California home prices and affordability. The California Association of Realtors puts out this content once a quarter, and they share how affordable is it to buy a house right now. And so if you look at Q1 2024, the median priced home was $814,000 in California. And in order to be able to qualify, you needed to have an income of $208,000 for your household. So what that means is only 17% of California households could even afford the median priced home. Now, there's a lot of factors at play. Obviously, interest rates going up has hurt home buyers and their affordability. If we look back just 1 year at Q1 2023, the average home was priced at $759,000, and the income needed to buy a house at that time was $188,000. So even then, it was super expensive. People could barely afford to buy homes. And so as we're seeing here, more and more people are getting left behind and falling out of the housing market right now. Last year, Q1 23, 20% of Californians could afford a home. And as of this year, 17%. And with these new prices, it's probably closer to 15% or less. So this is a major problem. We are having a crisis. And why is this happening? Well, it all comes down to supply and demand. So if we look at this next infographic, this is specific data for San Luis Obispo County. And if you're listening, you can go to our YouTube channel to follow along with the slides and the graphs. But basically what we're seeing is back in 2008, the number of houses offered for sale on the open market was over 2,500. So if you're a buyer, you've got options. There's a ton of inventory, 2,500 plus homes. And then as you go on each year, you can see that inventory start to decline, where we were floating around 1,200 houses. That was kind of the norm for about 10 years. We had a decade where there was about 1,200 being offered. So that's kind of more of a normal market for San Luis Obispo County. And then the pandemic happened. Interest rates got slashed down into the twos, and people were wanting to buy homes, bigger homes, work from home. I need an office, need a desk. I can commute from the Bay Area by Zoom. I don't have to go into the office every day. And so there's just this massive demand. And so the inventory plummeted down to about 450 houses at the low. That was like the very bottom, only 450 houses for sale when normally there was 1,200. You can see the problem, right? And that number has kind of picked back up. We're floating around 500 to 600 houses being offered for sale right now. That's still half of what the inventory was just a couple of years ago before the pandemic. And so what did that do to prices? We know supply and demand are what drive prices. So you can see this infographic where in 2008, when there was 2,500 plus homes, prices dipped. There was a lot of supply, but not a lot of demand. People were losing jobs. They couldn't afford to buy. And so pricing actually dipped from a median sales price of about 525 in SLO County down to a bottom of $300,000. So that would have been a great time to buy, right? And then there was a huge bull run. Prices just that decade, the 2010s, started to pick up and up and up. And then the pandemic happened. Rates got slashed and prices did about a 30% jump in about 2 years. It was insane. And so you can see that in the infographic here. Where we are today, prices have kind of stabilized. It's kind of plateaued. We're not seeing prices jump up. We're not seeing prices drop off. So we're kind of plateaued. And the real true driver behind all of this, why are we having a shortage of homes offered for sale? Because we have a massive inventory shortage. So the next graph we have here is showing homes built by population or versus population growth. So going back to the 50s, we started to have the baby boomers. And in the 40s, there was only 10 million babies born, or 9 million babies born in America. That jumped in the 50s to 19 million babies born in that decade. So within 1 decade, we doubled the amount of babies being born. That's why we called it the baby boom. In the 60s, there was 28 million babies born in this country. And so people realize we need to start building houses. All these families are being created. These babies are going to want to grow up and buy a house someday. So they built a ton of houses, averaging about 20 million housing units for the next several decades between the 50s, 60s, 70s, 80s, 90s. And in the 2000s, there was a big boom. They actually built 32 million units of housing product. Population continued to grow. But in 2008, once the financial crisis happened, a lot of builders went bankrupt. They stopped building. Banks seized up the funding. They're not lending to builders. So that next decade, the 2010s, there was only 6 million housing units built in the entire country. And the population kept growing. We had over 20 million babies born in that decade. So where are those babies going to go? The millennials, they're coming of age. They're starting to have families. They're wanting to own a home, live the American dream. They've delayed their home purchasing up until about their 30s and 40s because it's become so expensive. And so we have all these factors at play. Inventory low, demand strong. And another factor at play is cost of lumber. There's really 3 drivers when it comes to real estate values. Of course, supply and demand is going to play a huge part, but there's land, labor, and lumber. The cost of building isn't getting any cheaper. If you think about it, we're not building any more land, right? It's a fixed amount of land that we have available in California, especially on our beautiful Central Coast. There's a lot of preserved open space. And so we can't just build endlessly. We're limited by the constraint of land. And then there's labor costs. It's not getting any cheaper to build a house right now in California. In fact, it's getting more expensive because less people are going into the trades, becoming contractors, electricians, and they're going to college to try to get a higher education and degree so they can earn more money. So we're having a shortage of labor. And you can see this in Europe. Their population has been dwindling for several decades, more than here in America, and they have less people going to the trades. And so it's really hard to find a contractor or handyman to do work in Germany. And so building costs there are extremely expensive, as well as other places in Europe. Then, of course, there's lumber. Just the cost of material has gone up so much. For example, back in 2020, before COVID and the supply chain, you could build 10 houses with $50,000 worth of lumber. Within 1 year, in May of 2021, $50,000 worth of lumber would build you 2.5 houses. So that just shows you like, whoa, prices went up, not just for lumber, but for nails, for stucco, for steel, for roofs. Every single component of what goes into a house has gone up in value. So that's these prices we're seeing. They're not just inflated because there's a bubble. They're inflated because there's hard costs that go into building homes, the land value, the labor, and the lumber, and that's driving prices up even higher. Now, inflation is also a big factor in why real estate prices have gone up. Real estate, unlike cash sitting in a bank, is an asset. It is a fixed, it's a property that holds its value. So whether inflation goes up or down, your real assets will also ride along with the inflation. So if you look at this graph, it basically shows you what inflation was looking like starting back in the 2020 March, and then what happened afterwards. And you can see that January 2021, March 2021, inflation just took off and started climbing up to almost 9%. And that's like year over year. So inflation was really, really peaking. We all felt it. We all saw it when you filled up at the pump or went to the grocery store. Eggs are more expensive. Like, what is going on? And it was caused a lot by the supply chain issues, but also just the cost of doing business has gone up so much added regulation and rules that has made it more expensive to buy a standard grocery basket of goods. So inflation has gone up. Wages finally have caught back up to inflation. And so people are now earning enough, but there's still a long way to go before we can cure that gap, because people are, it's hard to afford. So all that being said, prices, they've gone up and inflation's gone up, interest rates have gone up. Only 17% of Californians can even afford to buy. This seems all doom and gloom. Like, why would I even want to consider buying real estate? Well, real estate still remains one of the best investments, especially long term. If you look at this infograph, we're looking at the median sales price for a house in America over the last several decades, going back to the 1960s. So in 1960, you could buy a house in this country for $19,000. Imagine that. A house for $19,000. That's cheaper than a car today, right? Most cars, if you bought one off the lot, are going to be way more expensive than that. And so during the next several decades, real estate has continued to climb, essentially at about a 3 to 5% rate of appreciation. So it's matched inflation or done better than inflation. And so even in periods of recession, real estate has weathered the storm. So there's these gray bars, and it shows these recessions in the 70s and 75, 1980, 1990s, the early 2000s recession, the 2008 recession. Each of these recessions was, you saw real estate really do well for the most part. The only big recession that hit real estate values was the 2008 recession. And you can just look at the numbers and the data and know why, right? We saw the inventory was massively high. The demand was super low. And so prices plummeted during that time. That recession was caused by the real estate industry. So that is unlike these other recessions that we've faced. And so real estate continues to climb. And so today, real estate prices have essentially, they've stabilized. They're not going up massively. They're not going down massively. Why get into real estate now? I mean, if you look at this graph, the best time to have bought a house was like in 1960. And if you go back in time and talk to anyone in 1960 who was trying to buy a house, do you think they're going to tell you it was easy, it was cheap, it was like we totally did it? Well, probably not. At the time, it was all relative. $19,000 for a house was probably a lot of money because wages were also way less during that time. And so when asking the question, when should I get into the real estate market? I mean, the best time would have been 20 years ago, and the second best time is today. It's an old Chinese proverb. And so why buy real estate? There are these real benefits that you will start to experience. Number one is financial security. Your rent isn't going to be going up every single year because once you get a home, you have a fixed rate mortgage that stays the same for all 30 years. In fact, rents are going to keep going up each and every single year, but your mortgage is going to stay the exact same thing. So the longer you stay in that house owning it at that rate without refinancing, you're going to be doing better than renting. You have that fixed rate mortgage, which gives you wealth building potential over time because you get that principal pay down. You're going to be writing off the taxes. Your interest is deductible. Your property taxes are deductible. There's all these tax benefits that you get when you own real estate rather than rent. It's also a tangible asset. So instead of owning paper stocks or bonds, you get to see it, feel it, touch it. And that means you can improve it. You can do some DIY projects, put in some sweat equity, and build appreciation. You can't do that with a company or a stock that you buy because you're not going to be able to add value to that company versus owning your own real estate asset. And then there's obviously the benefit of it being a hedge against inflation. And if you keep it as a rental, you move out down the line, you have that rental income and protection. Okay, so all that to say, how do you do it? I mean, you just shared all these reasons why real estate has gotten way more expensive and more difficult to obtain. How am I going to do it? Well, that's where house hacking comes in. If you think about it, looking at that graph, it's only gotten more expensive the longer you wait. Real estate prices have continued to climb. Rates, they've gone up. Land, labor, lumber, all of those things are getting expensive. Can you really fathom or see a world where real estate prices come down? Barring a natural disaster, war, or some serious government intervention, I don't see that happening. And so, that being said, how can you get in? Right now, if you bought that median price home as of Q1 2024, your payment, according to the infographic, was going to be about $5,200 per month. And that's just your principal and interest. That's not including your taxes and insurance. So you're going to be paying about $6,000 a month for that median priced home. Seems insane, doesn't it? Well, what if you were able to rent out a portion of that house, generate $1,500 to $2,000 in rental income by renting out some rooms or converting your garage or the basement or the attic into an ADU, which has become much easier to get approved. You can go back and watch our interview with Chris Allen, the architect, on what it takes to convert existing space into an ADU. Even an ensuite, like master bedroom type setup with a separate entrance, you could convert that to a junior ADU and have that be a completely contained separate unit, which you rent for $1,500, $2,000, maybe $2,500 a month, depending on your market. So now you took that $6,000 expense minus to $2,000, it's $4,000. Okay, that's still expensive. How am I going to afford it? You're still going to have income. You're still going to have to minimize your debt and have a down payment to buy a property. But if you could get in today and only have $4,000 come out of pocket versus $6,000, it starts to make more sense. And as time goes on, rents do go up, but that mortgage would stay the same. So if you can weather the storm, get in to the market, rent out a couple of rooms. It's called border income. If you're like you bought a 3-bedroom house and you're renting out to individuals, you can use some of the income. Talk to your lender about this. It's called border income to help you qualify for that loan product. So that being said, California is expensive and it isn't getting any cheaper. They're not making it more attainable for the everyday person. They are doing a lot of building projects right now, which is great. We are trying to build, but as we saw, we are several million housing units behind where we need to be. So instead of waiting for government intervention, instead of waiting for the market to crash, instead of waiting for the stars to align, build a game plan today to help you get into a home you can comfortably afford. And that's what we're all about. Instead of buying in the premier location, buy in a location that you can afford. Instead of buying the house that has all the bells and whistles, maybe take on a fixer-upper project, because you can't change that purchase price. You pay that purchase price, and then you're going to be paying interest and property taxes, all based on that price. But you can always refinance and get a lower rate. And if the market continues to go in the direction we're seeing, where there's been some softening in the job market, some yellow flags they're starting to say indicating recession, rates could be coming down in the next year. As they do, that will bring a lot of relief to home buyers and to people who bought at a 7% rate. If you could refinance at a 6 or maybe in the 5s, you're going to have even lower monthly payments, which save you hundreds of dollars a month and help you build equity even faster. So thank you all so much for tuning in to this episode of the Happy House Hacking Podcast. If you want to learn more, subscribe to us on YouTube. Check out our videos. We're always dropping new content and putting on meetups to help network and help other people get into real estate investing. And we're here. We're happy to serve you and your real estate needs. If you want to chat more, send us a message. And thank you so much for tuning in. Happy House Hackers. This is Owen Schwaegerle signing off.